So this is the Millionacres Hour, and we're going to do something a little interesting today. We're going to talk about real estate crowdfunding. A couple of reasons we want to talk about it right now. A lot of activity happening. A lot of, like Emily and us that we're talking about. There's so much speculation right now, and that's sort of drifting into real estate crowdfunding as well. So we wanted to talk about that. Want to answer your questions during this hour too. So pop those in Slido, and we'll get started with Matt Talalo. Hey, Matt.
Hey, how you doing?
So you've been writing a lot of the crowdfunding reviews and kind of updating our reviews from last year. I feel like crowdfunding is sort of shifting in a way. I know that there's been an uptick since the pandemic. I feel like there's some not as smart money getting involved in it. Is that your sense too?
Yeah, I've been following it, for a couple of years. It all started with the Jobs Act of 2012 that kind of opened up private real estate investing to, just the normal everyday investor. And they've been trying to figure out, like the best ways to allow investors to participate in that. And they've had to do some different things. Like, so for example, if a public traded REIT, it has shares. Well, they can't always issue shares of REITs just because of how like the SEC guidelines are for some of these things. They're trying to figure out the best way. And there's a lot of just covering some of these shady things that we've uncovered, REITs that really aren't involved, in things that we could even possibly recommend, where there's some lawsuits going on and stuff like that. So it's really one of the wild west of investing that, on the real estate side that we've seen. And but there's some good stuff out there. That's kind of what our job is, Million Acres, is try to sift through all this and give readers and listeners, what we see as being good and what's not. We're going to talk about some really good stuff too.
Absolutely. And I think one of the things that we're seeing is it's a good thing because there's curiosity in real estate, in alternative methods. There's a lot of good ideas here, and there is smart money in here too. It's just that when everybody starts to discover something, as you mentioned, this is really relatively new. I always compare it to REITs, and when you look at REITs, they started in 1960, and REITs go through, historically went through a really kind of a growing pains for the first, I'd say, 2 decades before they kind of got into legitimacy. And I think crowdfunding, real estate crowdfunding in particular, is kind of on that path to some extent.
Yeah, and some of that's because of who founded these companies. Sometimes it was real estate executives who know the market, and sometimes it was technology people that know technology. So you had those kind of two competing things. You had real estate operators that were just, we want to make good deals available to everybody. And then you had the technology, we want to make this, use technology. And it's taken some time to kind of marry those two ideas and get it right. And, we went through a really big downturn last year. And that was one of the kind of the big things of how would crowdfunding, companies handle this downturn. And that was what surprised me, is most of them survived. I thought Warren Buffett has famously said, you see who's swimming naked when, the tide goes out. And surprisingly, most of these weren't as, highly levered or into speculative things as we thought. So that was a good thing. It suggests that the industry is actually, not doing poorly. There's some smart people behind it.
True, but there were some that either didn't let you take your money out during that period or stop distributions. There was a little bit of that, but that's kind of normal. I mean, we saw that on the REIT side with certain companies, pausing their dividends. So that didn't concern me, but it is something that happened during that.
Yeah, and that's where these companies differ from REITs. So a REIT, it has liquidity, which means you can go out and sell shares, buy shares any day the market's open. So you can convert it to cash anytime. Real estate isn't like that typically. You own a house, you have to list it, wait for a buyer. It can take months to turn that into cash. So it's an illiquid asset. And a lot of these crowdfunding platforms, they are pretty upfront. This is an illiquid asset. And that's by design, because the point is to get rid of that correlation to the stock market. These are designed for people that don't want the daily ups and downs of the stock market. They want something that's much steadier and based on the actual value of the real estate instead of what investors are willing to pay for it. So when these companies suspended their the ability to redeem shares, it was part of that. We don't want to have to sell properties during a downturn and sell at fire sale prices, so we're just going to hold back shares. And that was an investor protection, and so that's one of the good things. But where there's good, there's bad a lot of times.
Absolutely. And you had these two kinds of things happening last year. You had residential market stopped and then went crazy. And then you had the CRE market, which really, really kind of stopped and stopped, and prices didn't go down, which a lot of people were expecting. There was a lot of distressed asset capital that sat on the sidelines for most of the year because prices didn't drop to where it could really be deployed. Now you see construction is getting back on track. Crowdfunding brings in equity and debt together. You see some more. You just see people being more confident. Even the return to travel is starting to make hotel investments feel a little bit more popular, and office is still a question. But the residential market and everything that's happening there, I think, has a lot of these real estate crowdfunding platforms that invest in multifamily feeling relatively optimistic.
Yeah, and that kind of goes back to what you're looking for with these. There's so much out there with what they offer. Some of them are only available to accredited investors, which are high net worth, high income. And then some of the others are open to anybody with they'll have a minimum of $1,000 or $5,000. And in order to get that low minimum, a lot of them have to offer REITs that are much more conservative. So they'll invest in multifamily properties. And so, that's just how they're able to operate in this private market, how they've kind of gotten their foot, in the door is focusing on multifamily, because that's traditionally been a very solid, stable way to generate cash flow. And that's, if you were going to, for example, invest in real estate on your own, what are you going to buy? Probably a rental property, maybe a single family home that you'll rent out, maybe a small apartment building. So it's kind of mimicking that in the private market. It's a way for investors to do that, diversify, and not have to be a landlord.
Absolutely. And I think it feels safer too, just because you can look at those long tail trends of, household formation and population, and kind of it feels more understandable perhaps than some other aspects of CRE. But go ahead.
I was just going to say that, going back to the whole topic of knowing what these companies own and understanding that's really what it comes down to with these crowdfundings, understanding how they operate as a business, knowing what their business model is, what they're focusing on. And that's going to be, key thing for investors. Know what you want to own in this. I mean, just investing in something because it's popular or because it's different, you really have to understand, who's behind these REITs, these crowdfunding platforms, what they're owning, what you're buying. Are you buying shares? Are you buying some sort of token? There's just so much that goes into this, and that's what makes it exciting in one sense, but also just this whole Wild West aspect of it.
Well, you just mentioned tokens, so let's talk a little bit about that, because that is really sort of the like Wild West part, even further out in the wild West, because, and it's something I've been following for a few years. I mean, I don't remember how many years ago, the first tokenization project was, I believe, the St. Regis in Aspen. But you've been hearing about blockchain and tokenization coming to real estate for, God, it's got to be at least 3 or 4 years now. With NRTs, that's, NFTs, that's a whole non-fungible tokens. That's a whole other thing being layered onto this. We're starting to see that being used in real estate, both selling digital real estate, and I've also seen a couple of properties now where the NFT is sold with the physical property. Feels like a publicity stunt at this point, but I feel like it's perhaps the beginning of trying to figure out how these assets work, the online NFT and the physical asset work together.
Yeah, it's really out there when you think about it, of just some of the things that they're coming up with. But it goes to the whole idea of cryptocurrency and what they're trying to do with that is
Mhm.
a lot of it's the trackability of payments and understanding, keeping the whole blockchain is all about keeping track of things. And it has a really good possible usage in real estate because we're trying to, you pay title insurance, for example, when you buy a house. Well, if all this is on a blockchain, you would know and you wouldn't have to do all this title research and things like that. So there's companies out there that are doing that sort of thing. But it's so new and so flashy in some sense, as
Yeah.
you mentioned, that it's really something to just be very careful of because, you know, we don't know what it's going to turn into and what's really backing it. What are you buying in a lot of these things? Are you buying common shares of a REIT, or are you buying some sort of token that represents, an ownership interest in a property? And that's where it gets kind of dicey.
Yeah, that's true. And you mentioned the potential for blockchain for transfer of title. Some other countries have been looking at that. I believe it was Sweden that was testing that out on a small level. I mean, the potential is there, and the potential for that sort of seamless transaction, having this sort of unbreakable digital record. It's a really great idea, and I think that's why there has been this buzz about real estate and blockchain for so long, but it hasn't quite gotten there yet. And I don't know if it's an idea whose time hasn't come yet. I think part of it is just the fact that title itself, as anyone who's ever dealt with a real estate deal knows, is just it's so paper based still. It's amazing how much doesn't exist in digital form yet. So I think that's part of it too.
Yeah, and that's just one of the many things that you kind of get into as you delve into crowdfunding.
Absolutely. So let's talk a little bit about crowdfunding and the difference between equity and debt, because not all crowdfunding, real estate crowdfunding, is the same. Sometimes you're the equity part, but there are also different crowdfunding platforms that are just on the debt side as well.
Yeah, so if you're familiar with REITs, you have equity REITs, which will typically buy a portfolio of properties, and then you have mortgage REITs, which will buy a portfolio of mortgages, or sometimes they'll underwrite loans. And it's very similar in crowdfunding. So there's platforms out there, for example, Ground Floor, they will sell investors for, actually it's very low, $10 a piece. You can get little bits of a loan that's used basically to fund flip and fix properties. So that's one way. It's real estate backed. So if the flipper isn't able to turn the property over for a profit, that real estate backs it. So you're not going to lose your total investment like you can for an equity investment. So there's different ones out there that are doing that for accredited investors. And then on the equity side, there's a lot of them that'll offer REITs. They'll offer different real estate funds, sometimes single properties, like you could buy a office building in a big city. Sometimes they'll do something like that, or a hotel. So there's so many options out there, which makes it really fun. But unfortunately, most of them are limited to accredited investors. So there's not as many options out there for those that are getting started.
True. And yeah, that is the bummer. If you aren't accredited, if you don't have that net worth, you're investing mostly in those REITs that are a collection of different properties. And so you don't have that journey necessarily, and you don't have that big capital return at the end when a project is sold. Now, you also mentioned ground floor, and ground floor is interesting because, and this brings up another thing that I think is important as a distinction, is between the difference between investing in a company and investing in a project, because a lot of these real estate crowdfunding platforms are also raising money for the companies themselves. And I've had people email me because they weren't really sure what they were investing in when they see this on some platforms. Ground Floor, for example, just raised, I think like 7 million or so through Seedinvest. And I think it can be confusing to people because it's a real estate crowdfunding company, but it may not be raising money for individual projects. So that's an important thing for people to keep in mind when they see some of these offers out in the wild.
Yeah, and these companies, they need money to kind of get going and to get started. to be able to hire people so that they can vet more deals. And also some of them are preceding deals. So Ground Floor, for example, I'm an investor on their platform, and a lot of times they'll precede the deal. So it's a closed deal, so you don't have to worry about closing because they put up the money to fund that, and then they'll sell that off to investors. And sometimes they're even funding portfolios. So you can invest in like a portfolio of loans that they've already backed, and then they'll, sometimes cut them up into smaller pieces and sell them off to investors. But it takes capital to do that, and that's why they're raising this money, so they have the funds for their crowdfunding platform to market, so they can get more investors on their platform. So they're doing a range of things with that capital.
Well, let's talk about Fundrise, because you and I are both Fundrise investors. I believe it's the biggie in terms of advertising. I feel like Fundrise has sponsored like every newsletter or podcast. They're pretty aggressive about it, and they're big. They've got around 150,000 investors, which is pretty impressive. They just raised 300 million in a credit facility with Goldman Sachs. And I find it interesting what they're doing, because they're all in on build to rent single family residences in the Sun Belt. And if you've watched the Millionacres Hour before, you and I have talked about the Sun Belt trend being huge, about the single family rental trend being huge. So this works with the theses that you and I have been thinking about.
Yeah, they've become one of my favorites over the years as I've kind of dabbled into this, because they really have a well-defined strategy. A lot of these, they'll just throw up, different REITs, and you can kind of always think of them as like SPACs. They'll, hey, we're going to raise money for this new REIT. It doesn't have any assets yet, and you're just buying based on what they say they're going to do. And over time, that was part of Fundrise's model. They did a lot of single properties at one time, but they've kind of combed into this Reg A E-REIT, they call them. And it's, it's basically just a real estate, public real estate investment trust that doesn't trade on the stock market. And they've taken the strategy of these from, we're going to invest anywhere. And they've really initially started on affordable housing. They saw that, so they would buy a bunch of apartment buildings that they could do value add projects, renovate kitchens and those sort of things to raise rents. And they've taken that and focused more on the Sunbelt region, because that's where a lot of people are moving and it's growing so fast. And then in addition to that, they've just in the past year, they've gotten to single family rental properties, because the millennials really like that concept of owning a home, but not having to, or having a home, but not having to own the home and all that goes into that, because it gives you flexibility. You don't have to worry about selling. And they have a really unique strategy that they're doing. So for example, Invitation Homes is a big REIT out there that buys single family homes, but they'll buy a property here or there that's already built. Typically they don't get into development, but it's Fundrise. They're actually, in a sense, funding development. They'll partner with a big national home builder who's building a community, and they'll say, we'll buy all your homes in the community, and they buy them in tranches. So let's say the home builder finishes 8 a month, they'll buy those 8 in one simple closing, and then they'll go out and lease that up. And that's, for them, that's a value add strategy, because they're not paying up for already cash flowing properties. There's some risk involved that they won't get tenants, but not so risky now, because there's just not a lot, everybody wants a house, and this might be the only opportunity you have to have a house. So it's a really interesting strategy. It has a lot of high return potential over the long term, and Fundrise is one of the few ways that you can get into this, especially the way they're doing it. Just a really unique play. So I like their strategy. I like their management team and how they're kind of really focusing on this.
So do I. And, they bought that first community last year. I believe it was 124 homes through DR Horton for 32 million. They're doing more of those. I like this also as someone who invests in home builder stocks, because this makes me think that it's starting to become a backup plan for home builders. And I think we're going to see that play out, especially as we're seeing some starts of, I wouldn't say unsteadiness in the residential market though, but we're getting close to that inflection point. Prices are so high that we're starting to see just a little bit of slowdown, a little bit of uptick in inventory we've talked before about lumber costs and, what are they up to 200, 300% year over year? The supply chain is still a little bit of a mess. So all of that is putting pressure on home builders. So it's nice to know that the home builder stocks that we invest in, a lot of them kind of have this little backup plan. So the two kind of go together in a way that makes me feel a little bit more comfortable about things on both sides.
Yeah, because that's always been a problem with home builders is the housing market cyclical, and they'll hold an inventory of buildable lots that they can't build sometimes because there's no demand. So this is a way for them to suddenly sell off those properties and really have like a pipeline that's much more visible where they know the sales are going to come in. They can get a guaranteed price, and it really works out for both because Fundrise can often get houses for much cheaper than anybody else can get because they're buying in bulk.
It's true. One thing I wanted to mention about Fundrise too is you and I talked about this before. Is that they've I was working on a story and they mentioned that they didn't want to be called crowdfunding. They wanted to be called direct to consumer. And so I was thinking about that sort of, is that just marketing speak, or is that something else where there is this feeling from some of these platforms that crowdfunding has a negative connotation maybe, or, that what they doesn't quite fit the mission of what they're trying to do?
I think that crowdfunding definitely has come to have a negative connotation. We mentioned it earlier. It's become the Wild West, and so really it's semantics here. The crowdfunding basically is you're raising money over the internet for real estate in this instance. So it's direct to investor. It's all semantics, but they see it as a bad term maybe. And they really want to build the idea of they're partnering directly with regular investors. This is, a way for the average person to invest in, single family rental homes and not have to be a landlord. So, it's an interesting way they're going about it, but the concept's still the same. So still really crowdfunding.
True. And I just want to mention one other thing about Fundrise that I really like is their level of communication is really good, and their website design and how they have like a little timeline for projects. I mean, the returns haven't been crazy phenomenal, but one of the things I like about having money in it is I feel like there's a level of communication there. Certainly they I get these emails, your funds have been invested in another project. They really put the thesis of what they're buying, why they're doing it, what they expect to happen. I feel like the communication is really one of the things that's actually something I really like about it.
Yeah, it's a phenomenal platform for beginners, especially. Anybody can invest on the platform, but if you're a beginner and you want to learn, they really do a great job of detailing why they're doing something and why it makes sense and what's the long-term plan for the property. And it really teaches you how to become a good real estate investor. And as far as the returns, I mean, the returns have been decent. They've outperformed the public REITs over their entire platform has outperformed them since their inception. But yeah, I mean, you're not going to get like big, huge returns that you would in a development project. But the real difference here is you have that discorrelation with the stock market. So when stocks were going crazy last year, Fundrise was just, steady as it went. You might have seen a small dip in the net asset value per share. But that's the whole thing is you don't have those daily ups and downs. So it just really insulates your portfolio a little bit from volatility and so you benefit from that long-term investing in real estate. And the other thing is a lot of their projects are 5+ year projects. So you really have to have a long-term mindset. They're not fixing and flipping properties. They're buying communities that they intend to hold for the long term. So it's something that, good for if you're retirement focused and just want to invest in real estate in the long term, it's a good way to do that.
Yeah, and something that you mentioned there that I think is really important is having, you don't have to panic with something like Fundrise. There is a psychological benefit too of having some assets that are sitting outside of the stock market that aren't really connected to that cycle. Especially, we've been seeing so much volatility. It's emotional. It gets a little. It can wear on your brain a little bit. So just having this, it just, it's it's a long-term steady thing. You know, there are some rules about how long when you can take money out. That's something to be concerned with. You know, if this isn't some place you put money in and take money out, as we mentioned earlier. It's, you know, this is illiquid. They're using the money to, you know, to invest in real estate, so they can't just, you know, they need it to sit for a period of time. But there is that nice stability and that sense of not having a share to obsess over every day.
Yeah, and that's really why you would invest in these type of crowdfunding. You're looking for something that's not correlated to the stock market. You have a long-term mindset. Usually, you know, try to park that money for 5 years. Now, a lot of these have opened up the ability to redeem early, but there's a cost to that. Sometimes it's 3% of the net asset value. So that's something to, you know, because they're trying to put that incentive to hold the long term. So there's that disincentive to sell early. And you know, those are all good things. It's not like it's a bad thing that you have to pay. It's to make people invest for the long term, which is something we really, you know, try to push here at the Motley Fool.
Absolutely. Let's talk about YieldStreet, because that's another one. They just raised 100 million. They're planning to go public via SPAC. I know SPACs have fallen in favor, out of favor. It's hard to know where everybody is on SPACs lately. But YieldStreet appeals to me in some ways because it's got the real estate component, but then it's also got a whole bunch of other types of assets. They've been involved in art. They've been involved in shipyards and marine vessels, just a whole bunch of different types of investments.
Yeah, and so their premise is to open those type of investments up to the general public, because you know, whoever gets the opportunity to invest in an art collection, and you know, that was the idea for this. Most of their opportunities are for accredited investors. However, they've opened things up in recent years. They put together this, it's called the Prism Fund, which is open to non-accredited investors. I think it's $1,000 minimum. And, you know, that will invest in a portfolio of different things, you know, real estate loans, it'll invest in art, legal settlements, you know, so all these alternative investments kind of in one vehicle. And they're, you know, as the name suggests, it's all about yield. So it's a passive income generating vehicle. It's a way to get that non-correlated income. And so they're an interesting, you know, opportunity. Now these aren't all riskless assets. They had a notable marine vessel issue. I think it was early last year, where there was some fraud involved in the people that they lent money to, and they had to go after them. You know, and even just some of the assets, you know, the reason it's a higher yielding investment is because there's higher risk involved. But the Prism Fund, it gives you that diversification across all these different asset classes. So it's an interesting way if you just want something that's unique and non-correlated to the stock market and want some income generation. This is a unique way to go.
It feels a little bit more speculative to me, partly because I feel like they are less focused on an overall thesis, like a Fundrise or Realty Mogul or some of those others. And they're more focused on, as you mentioned, that yield idea. So they're more, to me, it seems like they're more deal by deal by deal, rather than like, okay, we believe this, so we're going to find deals in this particular sector.
Yeah, it does feel that way. One thing I will say is that they have basically bought a lot of these specialty finance companies that are behind these deals. So they have these management teams that have so much experience in this. I mean, not a lot of people have experience loading money backed by art, but they do. They have that. The same with the marine vessels, aviation. So they've hired the people or bought the teams that know this stuff very well, and that's why they've been fairly successful over the years. So but it's still, you know, not your average type of investment. So definitely some speculation in that sense, where, you know, who knows whether the art market, which, for example, you know, has gone up for years and years and years, maybe there's, you know, that's not going to be the case, and these won't be as valuable in the future.
That is true. And I've seen some other platforms starting to invest in art in this way too. But you're right. I mean, some of their stats, they've funded nearly 1.9 billion so far. they have claimed around 950 million in interest and capital payments back to investors. So that, that alone is a pretty solid track record. Like you said, they've had some issues with some of those speculative investments, but they do tend to hire people who know what they're doing. I interviewed Mitch Rosen, who's the head of their real estate division, on the Millionacres podcast. Very, very smart investor. Also said that they call him the deal killer around the office because he turns down a lot of things, and I think that's an important factor for all of these real estate crowdfunders, is to know that they do receive far, far, far more offers than they actually put on their platforms. I've talked to CrowdStreet before and Realty Mogul, same kind of thing. They receive a lot of offers and then they vet them. And then, obviously at Millionacres here, we have Mogul, the premium service, where we look at deals and kind of put another layer of an even stronger layer of protection on that, because there is so much that can go wrong with any real estate deal. And when you're involving other people's money, it's a really important thing to vet as carefully as possible. And so when someone says they kill a lot of deals, that's actually, that's really a good thing. That makes me feel better about things.
Yeah, and that's something we probably should touch on a little bit, is differences between crowdfunding platforms. Some of them are marketplaces. So YieldStreet is, in a sense, a marketplace where they'll have deals that will come to them or deals that they've underwritten, and they'll put that on there for investors to kind of purchase. Fundrise does something completely different, where they offer proprietary REITs. They fully manage them. They will buy the properties, so you're investing in two, completely different structures. And that's something that investors need to kind of, pay attention to, is the REIT managed by the platform, or is the platform offering shares of the REIT or of the thing? Because if it's internally managed, sometimes there's more oversight. Sometimes there is, on the other side, a little bit of insider dealing where they'll buy properties from one portfolio to another. So there's a lot that has to be looked into with these different platforms.
Absolutely. So let's go into Republic, which is another one that is really interesting. One of our team members on Millionacres interviewed Janine Yorio of Republic. They're planning to go into digital real estate too, which is really, really interesting. This idea of buying virtual real estate, and that where you sort of actually build a virtual city. And it sounds way out there, but then you start to look at things like Fortnite, and you start to think, is there potential here? Does digital real estate have a place in the future?
Yeah, that is really a $1 million question. It's something that I have no concept of, because I don't play those type of games or really know much about that. But it's been so big. As you mentioned, Fortnite is so huge. There's a couple that they have gotten into where they see a bright future, and it could be a really big thing. It's really hard as so real estate is real property. And so to kind of go into that digital real estate, you're not talking about a physical thing anymore. So, you're not talking about, for example, we talk about replacement costs. What's it going to cost to rebuild this? Lumber, steel, those things have value in the real market. Well, you get in the digital world, how do you value those type of things? How do you know what something's worth in that world? And that's why it's just such a wild west. How do you know if you're paying a good price? Will people even care about this 5 years down the road? So it's interesting, but it's very out there.
Well, and that's interesting too, is because when I was listening to this interview about it, my first thought was, well, you can't really have, you could just get more, right? But it actually isn't true. So they're on this platform called Decentraland, and the idea is there is only like a finite amount of space. And it sort of makes me think a little bit of Bitcoin to some extent. This idea that there's a limit there, that you just can't, keep making more of it, which you think in the virtual world that you could. But also talking about the idea of, what do you do with that real estate? Do you just have it? Is it possible to actually, in the future, if you had this real estate that was valuable, rent it out or things like that? it's very, very out there. It's way early days. It's super speculative, but it's something that's intriguing and definitely not not something that we would like recommend at this point, but something to be aware of.
It's almost like when you're looking at gold versus Bitcoin, because they're the kind of proxies for each other. In one sense, they're the inflation hedge. And gold has some utility because you can melt it down and make jewelry, for example, and enjoy the jewelry. As you mentioned, properties, they have a utility. You can rent it out to a physical person. That's where I have a hard time understanding these concepts of things that really don't have a utility yet. Yeah, I know you can use Bitcoin, for example, as payment, but with as much as prices of it go up and down, that makes it hard to be a currency. So it's trying to find out what's the actual utility of these things to put a value on them. And I'm going to be watching it, but I would not put money in it. It's just so hard to figure out.
Yeah, I think it is very, very hard to figure out. But Republic also has a lot of other things you can invest in. A lot of it is investing in startups, and some of those are real estate startups. One of them I wanted to bring up that I saw when I was looking over there was the Austin Flipsters portfolio, which was a portfolio of fix and flips managed by a couple that is flipping houses, obviously, in Austin, Texas, and surrounding areas. And so the interesting thing about it was that it's like investing in fix and flips, but you're not investing in the properties themselves. This is one of those ones where you're basically investing in these people, and that they're going to do what they say they're going to do.
Yeah, so we talk about the concept of a SPAC. That's basically what this is. They're raising money to go out and buy fix and flip properties. Now, Republic has actually done another deal where it was a single property. It was a house in LA that a girl that is really good at fixing properties, she was behind it. And it actually just sold the other day for almost $2 million. I was in that deal, just, a little bit of money just to speculate. It's okay to speculate, every once in a while. And this is the same thing, this is speculative, but as instead of putting a lot of money, a $500 minimum for a portfolio of properties, fix and flip, high return potential, 15 to 18% internal rate of return, that's pretty good. Instead of going out and buying your own house and doing a flip, which costs a lot of capital, a lot of time, a lot of headaches.
A lot of risk.
Yeah, I did it myself. My wife and I flipped a house last year. We got lucky. It was the pandemic. It wasn't supposed to be a flip, but we ended up flipping it because the market was so hot, and it was just a renovation project, but a lot of work, a lot of things that we thought we were going to put money into. We ended up putting it elsewhere because the roof and the windows and all those things go. So this is a way to do that and have people that really know that market really well and really know how to flip really well to manage it. And they're getting paid pretty well. They get half of the profits on this deal. Republic also gets a lot of money for funding this deal. So, that really will eat into the returns, but it's a way to fix and flip properties. It's what the crowdfunding is kind of designed to do, bring these opportunities to the average investor. That's what Republic is doing. So it's an opportunity to do that.
Well, and that's a good point too, is that this can just be the sauce, right? This isn't where you're going to put all of your, your money or your retirement things, but sometimes there is room in your portfolio for those little bets, for the little pieces of money that you're like, okay, if I lose this, then I lose this. And it's not going to mess up my retirement plans. It's not going to mess up my budget. But I want to try this out. I think that's the perfect place to do something like that sometimes.
Yeah. And it's one of those things that makes investing a little bit, fun, where you can go out and do things, buy some cryptocurrency or put a little bit in a meme stock. The problem is that we've seen is people put their whole entire portfolio in, a Bitcoin or meme stocks, hoping to hit it big. And sometimes they get lucky, but sometimes they lose it all. But a little speculation on the side, I think it's fun and can be healthy.
And it also teaches you things. We learn when we lose money the same as we learn when we gain money. Sometimes we learn more when we lose money, but we also, at this point, there's so much happening in real estate crowdfunding. You don't really know what's going to end up working. So part of this for me, sometimes if I'm doing a speculative investment, I'm in it to learn. I'm in it to see, and maybe the money is the price of learning. Maybe this is like, it's like the money that you'd spend on a class. Instead, you put towards this, and you sort of watch it really carefully. You watch what happens. You learn what the company does right and does wrong. One of the most important things I think that you and I have learned in real estate crowdfunding is, man, communication matters so much. We hear that from all the crowdfunding platforms talking about the sponsors. We've seen it in Mogul. Matt Argersinger talks a lot about it. He's put together, he's now rating the investments in Mogul based to some extent on the communication of the sponsors. You want to have a platform that's communicative. You want to have people that are communicative. Sometimes that's hard to know in the beginning, which is why, looking at track records and things like that are really important, because these are the boots on the ground people. And if they're not telling you what's going on, then you don't know. And then that would make all of us nervous.
Yeah. And I think Republic, for example, does a good job. They're trying to build a little bit of a community. Each deal has its own profile, and they'll have like a discussion board. And a lot of times the two heads of the platform or the deal sponsor will get on there and answer questions. So they do a good job of that. If I have any problems with them, it's the fees. Not that they charge investors fees, but the fees to be on the platform. It's 6% cash plus 2% of equity in the project. That's a pretty hefty fee. It eats into the returns. But again, this is the only place you can really access that. So they have that the leverage to do that.
Well, let's talk about one more as we kind of get a little closer toward the end here, and then we'll take some questions. Just want to talk a little bit about Seedinvest, because it's a little bit straddling these two worlds of investing in companies and investing in real estate, because it's essentially you're sort of venture capital in Seedinvest. You invest in the companies. You usually don't get paid unless the company goes public. But I know Ground Floor, as we mentioned earlier, raised money through their Caliber, which is another real estate investment platform, raised over 10 million through there. So that's another one that that's out there and that people are investing in. But it's important to remember that with those, they are investments in the company versus investments in the real estate deals themselves.
Yeah, and it's really goes back to how you want to make money in real estate. Are you looking for that appreciation by the actual value of real estate, the income they can generate, the cash that you can get when you sell the property, or are you looking to invest in the platform? In the platform, for example, Ground Floor, they make fees. So let's say they list a loan on a platform, and the investor is going to earn 10%. Well, they might actually have put that loan out at 11% for the borrower. So they're making it on what would be called the spread between the two. So you have to look at how they intend to make money, and that's what's going to grow the value of the company. So it really, there's different ways of making money in real estate. Those type of investments in those platforms can be pretty profitable. That's why you see a lot of venture capitals putting money in those, because that's much more of like a growth stock type investment.
Yeah, definitely. So as we wrap up, let's talk a little bit more just to kind of wrap up for people some of the things that they should look out for. We've been talking about fees the whole way through. That's something that is really important. It's always tucked into the fine print of the offering circular, but make sure that you're looking at that and finding out where are they making their money? Are they making it through the investments themselves, or are they making it partly through the fees that they're charging? And that's an important distinction.
Yeah, fees. So we've reviewed almost all the big crowdfunding platforms. I think there's like 25 or 26 of them that I went through this year and did the refresh of them. And fees were a big thing that we look at. So anybody that's interested, please go on our website and check out our reviews to see which ones. And understand the fees are really tough because sometimes they're buried in SEC filings. So that's something that you have to understand, what am I paying? And it's okay to be paying fees. I mean, you're hiring management teams to invest capital on your behalf. It's just how much are they getting can be a big, eat into your profits.
Yeah, it's not a question of you're looking for no fees. You're looking just for where the fees are being used and how many and who's getting paid where and when.
Yeah, for example, there's some disposition fees that you'll see in some of these REITs. So the platform will make money as they sell properties, and we don't like that as a because that's a disincentive to be a long-term investor. They can sell the property to get some cash when we would probably as investors make money if they hold it longer term. So that's one fee to just look out for if they have those, something that might want to avoid.
Absolutely. We also talked before about that these are illiquid. You may face early withdrawal penalties. Every platform has its own rules about that. So that's an important thing that you want to look for as well. You want to look and see like, okay, if I have to pull money out, what does that look like? Not all platforms allow you to do that. The first year, some of them have, multi-year holds. There are also, some of them have windows of time in which you can do that and other times when you can't do that. So it's an important thing, I think, for you to know as you are considering investing in these, what are the rules on getting your money back?
Yeah, and that goes back to the whole thing that you're looking at here. These are not correlated to the stock market, so that liquidity, you're just not going to get it. That's, benefits and drawbacks. What's more important to you?
And the other thing we talked about before is your money being used for debt and equity, and also the timeline. The timeline is really important so for example, if you're doing like an opportunity zone fund, those have a longer hold. Some of the platforms are have a shorter hold. Some of them have, you're usually looking at least 3 years, but you can see 3-year, 5-year, 7-year, 10-year holds depending on the project. Right now, I know Fundrise in particular, but others too have been, because the market has been kind of hot on the residential side and also in other sectors, sometimes the timeline will be different. They'll tell you, okay, this is a 5-year hold, and then it sells in 3, or it goes the other way. It sells in 7. So that's something to keep in mind as well.
Yeah, just real estate in general, you have to have a long-term mindset. Hot markets, things can sell shorter, and even debt and equity. So a lot of times these platforms, their debt investments will be shorter term. They'll do a bridge loan for a project or maybe a preferred equity investment that has like a 3-year term. So those are shorter term investments that they'll offer. Equity can be, as you mentioned, 3 to 5 years. It all depends on what the business plan is.
And let's just go over one more time, Regulation A and Regulation D. Regulation A, that's for mostly people who aren't accredited, which is most of us. Accredited. You have to have $1 million in net worth, not including your property, or be making $200,000 a year for the past 2 years with the expectation of making it in the following year. So that's a barrier in place. With Regulation A, most of the time you're going to be investing in a fund where it's a REIT that holds a lot of different properties. It acts mostly like a traditional REIT where it buys and sells on its own. With Regulation D, you're often looking for those things that are you're investing in a single project. Bigger rewards, bigger returns, but also bigger risk. Sometimes there can be, there can be a capital call, and they actually ask you to invest more money. There's a lot of different factors there.
Yeah, so the really important thing is just to understand that these Reg A, which is what a lot of the crowdfunding things that just the average investor, it's going to be these funds, and so you don't have that ability to pick and choose what's in the fund, and so there really are limited options. If you want to target, I want to buy a beachfront condo in a beach town through crowdfunding, unless you're high net worth, that's not going to be an option for you. You're going to have to limited options right now, but they're expanding, so it's just something to kind of watch what they're going to expand into.
Exactly. All right, let's dive into a couple of questions. People are asking for tickers. There aren't tickers on these because these are real estate crowdfunding platforms. So you'll be looking on the individual platforms, and so you don't invest through a brokerage. Usually, you're wiring money in.
Yeah. So, for example, Fundrise, you're only going to have the Fundrise funds available to you. And in their case, you can't even choose, oh, I want the interval fund versus growth fund. I think they're up to like seven or something like that. They'll decide how much they're going to spread your money across. Some of the other ones, like Realty Mogul, there's two specific REITs you can invest in, and you have to choose, do I want REIT one, which is more of an income one, or REIT two, which is more capital appreciation. So each platform's different. You have different options available as well.
Next question from Max. Are these crowdfunding sites a member of FINRA?
So if they're Reg A and even Reg D, I believe they have to be SEC. So I don't know if they're members of FINRA offhand, but you are talking about things that are regulated, and that's a big deal because a lot of the back in the private non-traded REITs that would be available to high net worth individuals before, they weren't regulated, and that they charge these really high fees, and that was a problem. But these are regulated by the SEC.
Next question is from Rockstock. Thoughts on the future growth of Equinix? Last week we talked about data center REITs. This week we already had big data center REIT news. I know you wrote up the Blackstone deal with QTS. What are you thinking about data center REITs in the wake of that news?
Well, it showed that a really smart investor, a really great real estate investor wants that platform available to their private investors. And that, so Blackstone, they're on that other side. They're a private real estate investor. So high net worth, there's really no way that the average investor can get into some of these. And but public traded REITs, that's your option. Equinix, I think, is one of the best. I own shares of it. I own shares of a lot of them. Because it's just such a great market. Blackstone called it a secular long-term growth story because of the digitization of data, just so much data we need to store. And it's going to be a great trend. And I think their investors will do very well.
What are you hearing some of the rumors about other M&A happening in that space?
Yeah, so some analysts have already been speculating Cyrus One is the target that they think could be next. I just read a report for that for one of our premium services, and I'm really interested. I want to buy it after writing the report, but I'm locked out, and now I'm locked out again.
You just locked yourself out.
I know, but so that's one. If you want to do some speculating on something that could be a takeover target, but even if it's not, and that's if you're speculating in a stock, look for something that's going to be a good long term. So if you think Cyrus One would be a good takeout target, which it could be very well, there's a lot of private investors that want to own REITs, but it's still a good company. It's got a great it's in a great sector, so it's a good one to own. Any of them really, I think long term could do very well. So I own a basket of them, and I want to add that one to my basket. Someday I will.
Gotta stop talking about it. Question from West Coast Fool. Do you still like CrowdStreet? Yeah, we absolutely still like CrowdStreet. It's always a question of individual deals. CrowdStreet is for accredited investors, so you're investing into individual projects. And so each project has its own, its own thing. So with a platform like that, you really want to you want to look at all of the offering documents. You want to go to the webinar if you can and ask your questions. With those Regulation D accredited investor deals, you're investing, minimum probably between 10 and 25,000. It's being held for a long period of time. Really, really, really want to do your homework on that. But CrowdStreet has a lot of great deals, and we continue to look at them for Mogul and in general.
Yeah, I did an article that's kind of in the queue, and we rated all the crowdfunding platforms, and the best for accredited investors, that was right up there. CrowdStreet was right up there with Equity Multiple. It's another one, very similar business model. It just rated a little bit higher on our scoring system, and it was really because of a little bit lower minimums. Some of their minimums were 10,000 for accredited investors, so it opens the door to more people, and that was one of the reasons why I got the higher score.
Excellent question from King Kong. I've been thinking about getting into REITs with my IRA for dividends. Since I own single family rentals, would it be smarter to diversify in another way? I like rentals because rent doesn't go down. Currently own Redfin and Zillow as well, and leaning toward data center REITs, which I feel is diverse. Well, I think that's a really good point, because with REITs, you get the diversity within the REITs themselves, which we've talked about before. So if you're owning single family rentals, then you're covered on the housing side. So yeah, look at data center REITs, look at industrial REITs. There's plenty of other things, and real estate doesn't all go the same direction at the same time when it's sector specific. I mean, we've talked so much about industrial real estate and the fact that we at this point we can't build enough, and we can't build it fast enough because of the demand that shot up during the pandemic. It just keeps going with e-commerce.
And I think REITs also offer people like that typically, if you're going to buy single family rental homes, they're probably going to be in your own market. So not only is your primary home in that market, but a lot of times your single family rental homes are in that market just because it's easier to manage. So this gives you that geographic diversity that you really can't easily get unless you hire a bunch of property managers. And as you mentioned, just being able to target different real estate classes. I mean, to be able to buy a data center, even crowdfunding, you're talking 25,000 probably to put in one of these deals. REITs, anybody can buy one of these REITs and get that exposure to these great markets. So that's why we really like them.
And I know you like some of the diversified REITs as well.
Yeah. A lot of times with the diversified REITs, WP Carry is my favorite. Pays just a higher dividend yield. You're not going to get the growth, but that dividend yield, it just kind of, I use that income for speculative investments. It's just how I invest in my portfolio. So I'll buy growth stocks or some other things, and it just, that's just how I choose to invest it.
Next question from RA. What do you think of Latch? I also have PK Park Hotel REIT. They stopped dividends because of COVID. How do I find out when the dividend will start again?
I'm not too familiar with Latch, but I do know the hotel REITs. It all depends on how quickly demand bounces back. Some of these, they're still not generating actual profits as a company. The hotel portfolio themselves might be generating positive income, but when you add in the interest rate on their debt and that sort of things, the companies aren't making money. So they don't need to pay dividends until they get that net income that makes it taxable. I would think a lot of them should by the end of this year, provided we don't have, big second wave or fourth wave or whatever wave we're up to of COVID this fall.
And yeah, so Latch, they have a $1.5 billion valuation. They just began trading Monday through their SPAC listing. One of the things that's interesting about Latch, and one of the reasons I know that a lot of our team is really interested in it, I was following it before it was a SPAC, is the potential, I think, is what you're investing in with Latch. The revenue isn't there yet. It's known for smart locks, but the real thing here is they've just got so many really intelligent partnerships, and the amount of what they can do with this data once they start, really getting, integrating it with more things is pretty interesting. So it's on its way to becoming an apartment and a building ecosystem. They're just starting to get into commercial. And I think it's one of those things that there's just so much potential for what can happen there.